Hello, this is Mike Swanson of WallStreetWindow.com. Glad you're here. It's Friday, September the 9th, and I'll be speaking with Davie Skarica in a few moments. But it's been something else for the stock market today. I'm going to pull up a chart really quick. But the Dow, it finished down quite a bit today, 394 points. S&P 500 down 53 points. And, we broke down out of this narrow range, and this is the result. It's a mess. But what's really surprising is it isn't just that the stock market went down, but gold went down, gold stocks went down. But even more shocking than that is bonds went down too. Bonds are supposed to go up when the stock market drops. They didn't act as a safe haven. So what is someone to do in a market like this? What's your thoughts, Dave?
Well, look, what I really think with the bond market, and I'll show us a couple charts in a second myself, but what I really think is that in bonds, we've just exhausted ourselves to the upside. When you think what was going on the last 6 months, Japan, negative yields. Germany, negative yields. Like 12 or $13 trillion of bonds around the world, negative yields. It's insanity. What it was insanity. So what I really think is that we are just exhausting ourselves to the downside, to upside, and now we're breaking to the downside. So that's all that's happened. And at some point, the bond bubble, and by the way, bubble in the world. Because you look at the personal debt that people have. You look at the debt the governments have. If interest rates were to normalize, most average people in the world, in the Western world, and most governments in the Western world would be totally broke. You look at the debt to GDP in Greece, Spain, UK, US, all these countries, Belgium, France. If we had normalized interest rates, I'll be broke. Japan, obviously, is the major one. And I think that is what we might be in the early stages of. And the question is, are we going to see still one more last gasp blow off in the bonds? Or do we break down here, see a good rally whenever QE4 or whatever starts? After that breakdown in the markets, does that rally in the bonds fail? And then we go significantly lower for the next few years? Or do we see like a blow off here? That to me is the only real question. But I really believe that this bond bubble, and the bond bull market is 35 years old, which is extremely old for any secular bull market. Does it finally end? And a lot of the shorts I have are based on this cheap money. And most of the shorts I have obviously were down today, and a big down day today. One or two were up for whatever reasons. But I'm pretty happy overall today because on top of my put options, I have short ETFs and the whatnot, and I can't really complain about what happened today. So overall today. But what is going to happen going forward here in the markets? And by the way, we broke the support at 2160 in the S&P. But what I would think is going to happen here is that we're going to quickly decline, if I'm right, to the 2000 area, have a bounce there, and then really fall apart sometime in October. And do we just see another correction, or do we see a full-out crash? That's really the only question here.
Yeah, I agree with what you're saying right there. That's we'll be watching how this plays out over the next couple of weeks, because we'll get important clues by the way the market declines, the internals, and all kinds of sort of things to tell us whether or not it's going to totally collapse in October, or if it'll be like January, February, or August, October was. But one thing, I started out talking about the bond issue, and I'm really glad you talked about these negative interest rates in these different countries, because whenever the market makes a big move, the financial media always wants to look for an explanation for it. And really, the stock market had plenty of reasons to drop. It was set up to make a big move anyway, and it did. It was down. We've been talking about that for a while, over the past month. But the thing about the media, I turned on CNBC around 3:30, and they were saying that the stock market was down because people were scared that the Federal Reserve was going to raise interest rates. And Fed fears, they said, were causing people to sell stocks. And the reason why they would sell stocks is because stocks like Philip Morris that pay high dividends have been supposedly worth buying because interest rates are zero and the price of the stock doesn't make any difference, they say. And now all of a sudden, because they say people are scared, people don't believe that, and blah, blah, blah. But what I want to assert is these people on CNBC are wrong, that the stock market did not fall today because people are scared that the Fed's going to raise interest rates. The odds of a Fed hike in September were less than 30%. Going in today, they probably are lower even now. And the odds in December are 50-50. There's no reason to think the Fed raising rates is a high probability. It's not happening this month. That's not why the market fell. But they are right to assert that there are reasons to worry about interest rates. And those reasons are what you talked about, these other countries where the rates are so low, and there are big shifts that took place in those rates that spilled over into our bond market. And that's totally not talked about on CNBC. And that's the key factor, I believe. And I talked about that in a post I put on my website saying, watch out for the ECB meeting Thursday. That's really the big news item. And bam, it hit. No one talked about it on CNBC until it hit. Now it's hit. And even then, today, they didn't talk about it at all. So that's what's on my mind as far as a specific news item this week.
What I have on my screen, you can see it, right? The chart? Or
Yeah.
Okay, this is the German 10-year bond. And what you can see, it's actually gone positive yields from the first time since June, since right before the Brexit vote, which caused kind of a flight to safety or whatever. So, and you can see from this chart here, the yield, it looks like a major top in the bond and bottom in the yields is now in. And maybe we'll start moving back up slowly. So I think that's the whole thing. That a lot of the reason for inflated equity prices were people just saying, hey, negative rates in Germany and Japan and only 1.5% in the United States and Italy and England. Well, yeah, I will own stocks because why am I going to own bonds? But if this starts to burst, and look at the bursting doesn't have to be because they're raising rates. The bursting just can be because this is overextended to the upside, right? Negative rates make no sense. So if that occurs, that is going to hit equity prices because all of a sudden the premium that is in equity prices, because bonds say had no yields or negative yields, has got to start coming out, right? So let's look at right now. Europe is doing QE. England is doing QE. Britain's doing QE. Japan is doing QE. Everyone but the States in the Western world is doing QE. So what those countries are doing is probably more important than the Fed right now. And like you said, I read all these articles from European news outlets that Draghi was going to extend the QE. He was going to make it easier for him to buy these bonds. So the European Union has a rule, and I'm going to show you what the rule is right now. They can't buy bonds that are yielding less than their rate. Right now, the rate is 0.05%, so negative 5 basis points. So when these German bonds, for example, that I'm showing you right now, were negative 11, negative 9, negative 7, over the last few months, they couldn't buy them. So that was the other rumor that they would get rid of that rule. They did neither. And Draghi even said they don't even need any more QE right now. So that was just some rumor that was garbage. And now they're saying that Japan in a week or two when they meet are going to do helicopter money. That's probably garbage too. And one of the things that I own, and I've owned this for a few years, but it's now starting to pay fruition, this is the Japanese. So I started buying this probably in 2014. and average down all the way the next 2 years. And you can see it's starting to break out now. This is the 3 times short of the Japanese bond. And with the 30-year bond backing up, with the 10-year year bond backing up, you're seeing the Japanese bond starting to sell off and this speculation starting to pay off. But you're right. If these rates go up, all the things that companies can do, buybacks, mergers, the governments can fund themselves at these high debt levels. If the bond yields go up, that all ends, and it's the end game. And I've actually thought this was going to happen since I was a teenager 20 years ago. It's just taken a long time to play out. And if that happens in the next 5 years, it's going to be decimation for stock markets. It's going to be decimation for economies. And the welfare state depends on governments being able to fund themselves. They won't be able to fund themselves, higher rates. So that is really the epicenter of everything. So the question is, do you see one more blow off, or do we see a decline here followed by a rally that fails? And the one thing that's interesting about the S&P is that I really think that we're in danger of a crash at some point. And what all crashes do, and I'll even show you this in 2008 here, is all crashes have this initial decline and then rally, and then they fall off a cliff. So does this decline and rally happen this year, or ready to fall off a cliff this fall? I know that crash is coming.
Well, I'm going to show you two little news stories that are key. Is you mentioned the buybacks, and one of the things that has fueled the market of the past couple of years are corporations buying back their shares, and they've been issuing junk bond debt to do so. The individual investor as a whole has actually taken more money out of the market than put into it. Foreign equity inflows into the U.S. have been negative this year, and the bulk of the money going into the stock market to fuel it higher is corporate share buybacks, and they've been an explosion of that. Now, when we've both spoken about this in the past, so that concept's nothing new. What is new is what's occurred over starting in July, and I found out about it in August, and Bloomberg had a story that said that the corporate share buybacks, the announced buybacks, had collapsed. They had gone down to a level not seen since 2012. So to me, that was a sign that the market was on borrowed time, and an explanation for why the volume totally vanished in August. And the only thing that was keeping the market up were the stock buybacks that buy and support. But when support gets busted, they don't buy.
We call it robot trading, when these algorithm based hedge funds, like for example, the one short that was up today, I am sure what happened is this stock just bounced off its 200-day moving average a couple of days ago, and then the funds all jump in and they keep buying this for a few days or a week or something, right? So that's also what is keeping higher, because but you're right, that's a real key. And part of the buybacks, not this is the cheap money. Finally, the fact that we're seeing big declines in for example, I'm going to get my screen up in a second here just to show you something. But big declines, for example, in for example, corporate revenues means that companies can buy back less because they're not having as much cash flow coming in to buy back stock. One of the craziest sectors has been the oil and gas sector, where the amount of corporate debt in oil and gas companies has doubled since 2014 after this first decline in oil and gas stocks in the oil and gas sector. And the reason that doubled was they are just borrowing money so they can do buybacks and pay dividends. So they're not borrowing money in some fervor and a bubble we want to take over companies, we want to expand. They're just doing that to keep their dividends high, hoping that, okay, we'll take on this debt, keep our dividends and buybacks up, and then and hopefully in 5 years, when oil comes back, we can just make more money and pay down that debt. That is an insane strategy. Like, that is not going to work out. I don't even know how someone can even believe in this strategy. And these are people running multi-billion-dollar companies, and they're doing this. So this is going to fail. And what we can see in oil, this is really interesting right before you start here, is notice that every year, the last few years, and actually almost every year other than 2013 and even 11 and 12, we had this rally or strength that held up into the summer, right? I mean, other than 2013, or spring or summer. And then the oil stocks almost all tanked over the second half of the year, here. So it looks like we're doing the same thing here where we've held up and then we're going to tank here into the end of the year. And if you go look at oil itself, because there's so much debt in the oil market, to loans from banks, et cetera, and same thing, it started tanking in July in 2014. It started tanking in July in 2015. It looks like it peaked in June, July this year. And we came back recently. We're down over almost 4% today. If we break this 39, 40 area, we'll probably retest these lows and maybe even go a bit lower. I think that might be the final low in oil. But if that low happens, that is when a lot of the frackers, a lot of the people who are dependent on this cheap money, they're all gone after that. And I think that is the final washout we need. I will be a buyer when that happens, but I've been patiently waiting for that to happen.
Well, as you point out, that chart of, if you look at a chart of XLE, the oil stocks, they were a giant player in stock buybacks, but they actually stopped their buybacks in 2014 because the price of oil was falling, and by 2015 they had to cut them off. So that shows you the impact stock buybacks had on the oil stocks. When they're gone, there's no one, real buying going on except people desperately trying to guess the bottom, and then they sell out.
By the way, this is an interesting chart here. This is the XLE divided by the price of crude. And what you can see from this chart, I'm going to get a longer term chart so you can really see what's going. Okay, this is going back. Let's get it back. It only goes back to like the late 90s. Let's do this. And what we can see is compared to the price of crude, the XLE is actually back to the 98, 99 levels. So what's happened is the price of oil has gone down way faster than the price of the oil and gas stocks. And if you look at the real lows like 2008, 2003, that is, so I'm just getting over a cold. I'm not doing a Hillary Clinton impression. But 2008, 2003, that is when these stocks bottomed, when the XLE was trading at less than half the price of oil. Well, right now it's trading 1.5 times the price of oil, which it did here in 99. And if you go look at actually the XLE itself, just quickly here, Mike, before you take over, in that period, look at it in 99. If you would have bought here, okay, it went to a slightly higher high here, but it went way lower in 2002, 2003. So if you would have been patient, the XLE ended up falling about 40% from its 99 levels. So you don't buy this thing when the ratio is that high. Same thing in early 99. In early 99, okay, already fallen, but it wasn't really that low yet. The XLE didn't do much, from early 2009 to 2010, where the market had a huge rally. So what you want to do here is wait till that ratio shows you that oil stocks are cheap compared to the price of oil.
Yeah, exactly. And the thing about is that their decline, when the price of oil dropped, their revenue, of course, went down, and they just stopped doing the buybacks because of that fact. They, Exxon and all these companies, they don't all want to drive themselves into bankruptcy. They're going to cut spending when their revenue drops. And I want to show you this article that came out today in the Chicago Tribune, because it explains why the buybacks for the S&P 500 companies is grounded to a halt. It's because their balance sheets are now shrinking. Why is that happening? Because finally the revenue shrinkage, the earnings shrink, I should say the revenue shrinkage has been masked over the past 2 years by the buybacks. Because what happens is CNBC will say this company's earnings are growing, but they don't tell you their earnings are growing while their revenue shrinking because they're taking earnings out of the market. So earnings per share is growing. But when the revenue shrink, the balance sheet shrinks. And now apparently corporate America has reached the point where they have stopped or cut back, I should say, drastically the buybacks. So the fuel that supported the stock market is run out. And here we are able to see the market not decline, though, in August and up till this point because volume vanished, people aren't trading. So stuff was able to drift for a while. And that's why you didn't have a real breakout rally that could work in August. We just saw some gap ups and gap downs. That's why the stock market traded like a penny stock. But what happens when you have an illiquid penny stock that tops out? Well, it's not fun anymore. And I think everyone, has to adjust to that fact at this point, one way or the other.
Well, this is IBM. This is the exact kind of stock you're talking about. IBM's had 2 or 3 years of declining earnings. But why is this stock, it's still gone down from 190 to 155, but why has it been able, you see this rally recently. This stock has taken on a ton of debt and they're using that debt basically for buybacks. So that is why they've been able to hold up the earnings per share despite the declining revenue. The problem with that is if interest rates start to back up in the corporate bond market and the government bond market, then all of a sudden IBM can't borrow stock like that or borrow money like that to buy back stock, and they're finished. And this stock is going to go to $50. And that's what these companies are going to do. What's going to happen, it's going to be a big scandal. All you're going to see is IBM and Apple and all this, excuse my language, shit. What these companies have done is they're all borrowing money to buy back stock, say at IBM at 150 or 200, or or Apple at 120, 130, 110, whatever it is. And then what's going to happen is these stocks are going to be 50 in a bear market, and then all you're going to say is all that money they borrowed to buy back stock is now 40, 50, 60% underwater. What an absolute disaster.
Well, I'm going to show you something about IBM real quick, and then I'm going to where did the screen go? I want to show you something. The thing about IBM is they've done what you're saying, and it's been an ugly stock to hold. However, this is the insider sales data on Yahoo Finance. And over the past 6 months, the insiders at IBM have liquidated 10.8% of their holdings. So they've used the buybacks to keep the stock elevated and use that fact to dump their own personal shares. Letting their company borrow money while they to almost in a lot of cases to buy the shares they're selling to the company. And,
well, see, that's what's really kind of immoral about it is that
look at the money they're making.
IBM, Papa John's, Apple, they're all this. They are taking your money as a shareholder and buying back their own stock, and they're dumping it to the stock that they're buying back. It's actually a huge conflict of interest. There's no regulation against it. My opinion is when this bust comes, and there are going to be inquiries and congressional things or whatever, investigations into it, they're going to say, hey, these companies can't be buying back stock while the insiders are selling. It's a conflict of interest. Because how can you say, hey, our company is a good value, so we're using our company's money or the shareholders' money to buy back the stock at the same time where I personally are selling? So I think they might even come up with a regulation that says companies can't buy back. If you buy back stock in a quarter, no director can sell a share because it's a conflict of interest. I really think that will happen, but it will take a bust to happen when it shows that this kind of behavior has kind of like gone on or something like that.
Yeah, I mean, you may say something like that right now. You might say that right now, but you'll never hear someone on CNBC make such a statement at this moment in time, and no one cares. The CNBC viewer that owns IBM or Apple, they have no care in the world about what you're saying. However, let the stock market decline, let Apple fall. It's already fallen over the past 12 months, but let it fall more, 50% or something, and the Apple person sell finally and get mad, get tired of being a bag holder for the shareholders who've dumped 16%, then that person will get angry. They'll look for someone to blame, and then they'll start saying what you just said. But right now, nobody cares. And really, what we really need to focus on ourselves, we can't do anything about it, is how to make money out of all this stuff. So what do you think is the best way to profit in these markets? There's all kinds of wild moves happening. Gold had a great run, but now for the past 3 weeks, gold stocks are down, the bonds are down. It's like everything is falling. How can someone make money when everything is falling?
About a month ago, I made a shift, and I'm showing the S&P right here, is that in July, August, I really said, and I already had some shorts, and obviously they lost money when the market rallied, but I really said that, look, the best way we can make money here in the short to intermediate term in August is you got to be short. The gold stocks, which I'll show you in a second. In February, I said to my subscribers, the risk reward right here when the HUI was 110, 120 was being long gold. You got to be long gold. Stock market had a dump then. The risk reward is not shorting, it's being long gold. Now I'm saying the risk reward is being short the market. So being short ETFs, being short individual stocks, buying put options, whatever it is. But that is where the risk reward is being. And finally today, we broke. And I really think this was a significant break. I can see, look, no one thinks the market can drop anymore. That's the bubble right now. The bubble isn't so much that people are greedy. It's that they think that the central banks will just prop the markets up and they're not going to really go down. So it's more of a bubble in psychology than it is in behavior. That, oh, yeah, whatever, the S&P might go to 2,000, but whatever, it went to 2,000 after Brexit, right? But you can see this was a big break here. 2150, 2160 was a big fall. We smashed through that today. We were down 53 points. We're probably going to quickly fall to the 150-day moving average and maybe to about 2,000. I think when we fall to 2,000, we might bounce there. But then I think after we break that 2,000 area, we're headed back to the lows of February. And after that, we're looking at, let me get this right here. I think we're looking at some bad stuff.
One thing about that chart you're showing right there and what you just said. I think
we're looking at 1,500 after that.
Yeah, one thing that's kind of interesting though is, let's say, and I'm thinking the same thing you are, but let's say it does fall to that moving average or 2,000 and bounce. One thing that would be different about that scenario than the decline we saw in January and the decline we saw in August is there was no bounce on those declines. Actually, the market just went straight down, and it bounced and retested that low, and then it was able to do a double bottom. So actually, if it fell to 2,000 and bounced, that would set it up to have a different the decline would be of a different nature than the one in August and January, because the bounce would be from a higher level, or the pause or whatever it is. So that would be a little bit different than what we saw before. The other two times, it really did go straight down very quickly. But the thing is, the bounce scenario, the next decline would be horrible, if what we're saying is correct.
Well, maybe it bounces. That's the 150 day moving average, right? Yeah. Maybe it bounces there back to, maybe almost where we are today, 2120 or something, right? And then it tanks. But you're right. Like, when you look at the last couple of declines, when you broke that 150-day or 200-day moving average, the market almost went straight down. And what I think that's partly due to is how much of the day-to-day trading is controlled by algorithms and robots. So if the robots get turned off, they're not just buying the stocks off the moving averages anymore. And then the market breaks, and then there's nobody there to buy. And if the buybacks are gone, there's really nobody there to buy. So yeah, that's kind of I don't know. It could have bounced off. It could bounce. It could go to 2,000, bounce to the moving average, and then just decline there. But I do think that when it breaks, it's not just going to go down slowly because of the artificial nature of the market due to low interest rates, central bank manipulation, algorithmic trading, buybacks. That when it breaks, it's going to break hard, fast. Like, and you look at most crashes actually only happen over a 1 week to 1 month period, and the market just absolutely tanks 15, 20, 30% in that time frame.
Well, and the thing about the past couple of years is, we saw the stock market go straight up in 2012 and 2013, as you have right there in the chart. But we also saw bear markets where things went straight down for an extended period of time. That's what the gold stocks did. It's also what oil stocks did in 2014. So, but both of those two bear markets, those started with big initial busts off of the top that, lasted for a month or 6 weeks or two months, like kind of like what you're speaking of. So, we can't predict. No one can predict exactly how a price pattern is going to play out. And but you just need to know what the trend is and be alert to when the trend changes, as it is done today. Obviously, breaking support of the past 2 months, and then you've got to adapt. Go ahead.
I think you're short Tesla, right? And
yeah,
I'm actually short. On my short service, I'm short Tesla, but personally, I'm short another stock that is kind of like correlated with Tesla, right? Which I think has more downside too. But anyhow, you can see that Tesla looks like it's built this huge 2-year top and now is starting to roll over. If it breaks like 180 here, 141, and there's some support at like 116, 120, and then it can really just go, it could just collapse after that, So, and that what's interesting is Tesla was falling for a few weeks even before the market started to break here, So I'll show you the stock I'm short. I really don't care about talking about this one. This is NVIDIA. They do they're kind of like a chip company, and they do a lot of the electronic systems in the Tesla cars. And this company, you can see, has gone totally parabolic, crazy since the beginning of the year. I bought some puts around the $60 area. So whatever, the market, it finally broke today. But here's the interesting thing about someone who trades price action. In both the 2000, 2002, and 2007, two bear markets, you see NVIDIA had huge busts from 22 to 2, 60, 37 to 5, and now we're here. So this is a boom and bust stock. So if we are in a bear market, NVIDIA will probably go back to $10 or $20 a share, right? So I think this is kind of the short I like. And where is the upsides, right? You have to going from 20 to 60 in a year.
Yeah. Let me ask you something. This, we didn't plan this out or anything, but would you, I'm not going to, like my pay service, I don't know when I'm going to open it back up, but would you consider doing a thing on Sunday, for my subscribers to get in yours so they can get some of your short pick ideas? Just do it.
Yes, because actually,
Sunday one day.
Because my large is short and you're short the stock too. Actually, by some freak thing, actually went up today. And I think this is a company that's taken on tons of debt. It's in an industry that is super leveraged. It is a kind of stock that I think if you get a 20, 30% meltdown, this stock can drop 70%, in my opinion. So this is a great short, and I've got 5 or 6 key shorts right now. So, and then I've got a bunch of gold stocks on my radar. We sold a lot in the summer, into the fall. So the best case scenario is the market tanks, these shorts go up, and then we can turn around and buy these gold stocks in the fall. So if you're interested in that kind of trading, and you should be shorting as a hedge right now. Let me show you one indicator talked about.
Yeah, but just so people know, because I get all these emails right as you're loading this up, questions about the gold stocks. I haven't sold all my gold stocks or sold all my gold. I've got core positions, and that's how I manage my money. But I've been saying go to cash, raise, in emails and stuff, have cash reserves, have cash reserves. That doesn't necessarily mean sell everything you own, but it does mean you've got to be in a position to be able to buy later on. And for most people, they need to have cash in some sort or another so they can buy later, or else be short now, and they'll know they're going to liquidate those short positions, then can use that cash to buy. That's what I'm personally doing. I'm more short than I'm long by like 3 times or something, if you do the math. But
well, anyhow,
go ahead.
The chart I want to show is this GDP, which is actually Warren Buffett's favorite indicator, even if he never talks about it anymore because he's such a cheerleader now, right, for the markets. But what you can see is in the late 90s when we had this dot-com bubble, this is the housing bubble, and this is now that 100% GDP, meaning that the stock market cap is larger than the economy, it usually just means that the stock market's going to perform pretty miserably. And actually, in all of the history of the world, outside of 2000 or 2007, and now the market cap to GDP has never been over 100%. So we are so overvalued. Now, this is a long-term indicator. This is something that might not play out for a year or 2 or 3 years, but this is just showing you 2013, 14, stocks have been vastly overvalued, and at some point they're really, really going to break.
Well, we've only fallen one day, too. And last year, in around August, the beginning of August, we were giving people put ideas and short selling ideas. The big stock we were talking about then was Skyworks, and then it crashed. And then around New Year's, I released my short selling course to get ahead of a stock market drop. And short selling and betting against stocks is really something we kind of stopped talking about, maybe for 2 or 3 months or maybe 4. But now we really are talking about it. And the reason why is because this is the moment. We're only one day off the high. But we also learned from the last drop that you really got to do it early. The problem is a lot of people, they get interested in shorting after something's fallen for a couple weeks, so, and then it almost becomes too late. I really think this month is the window to do it. And after that, the opportunity is closed, because you got to get in, let's say right now you get on near the high. If we get a drop and then a little bounce, you got the little bounce. But after that, the opportunity to get in is really over, No,
you're right. What happened this year was I was shorting late last year in the summer. And then when the decline happened, I got all these people interested in shorting. And then the market bottomed and rallied. I don't know if this is going to be a correction or a crash. I still think we're going to have a bear market. We were 7.5 years into a bull market. The only bull markets longer than the 90s and the 20s. And those were economic booms. This is all central banks printing money, right?
Well, buybacks, and they're gone.
And buybacks and money and robot trading. It's amazing that it kept it up this long. And I'll tell a story about this in a second. But that's just the point, that we're very mature. We're in the 8th or 9th inning of this bull market. And when it bashes, it's going to be huge. And Gunlock, Soros, Icon, basically, and Kyle Bass, Burbank, anybody with half a brain is telling you this is going to happen. But most people want to ignore, and they want to listen to Michael Santelli or whatever his name is. Santoli, sorry.
That
the guy
right there gives me one more thought, and that is, I think the worst thing the stock market, you talk about different scenarios, what could happen. Actually, on Monday, people are probably wondering what's going to happen Monday. We can't predict that. But I would say this about Monday. I think the worst scenario would be if the stock market, which I haven't thought about till just now and would actually be very surprising, if today was a very big drop, right? If somehow the stock market actually fell more or about the same amount as it did today, another 350 points or 400 points on the Dow, another day like that, I actually think that would set it up to have a pause or bounce you're talking about. But I think that would be almost the worst thing it could do. It'd be something really disturbing about two back-to-back giant down days at this point.
Well, this is an interesting indicator too. This basically shows you what portfolio managers are doing, and this is managers that can go long and short. And what this shows is that if they're 90 or 100% long, they're almost fully long, right?
Yeah.
And you can see, actually, one second, I'm going to show you back to that. One second, I'll get it. 1 second. Use it. Second here. No, I don't want that. I did the wrong thing. 1 second. No, I'll get it. Yeah, let's get that. Show it.
For those,
this shows you, like, okay, when these fund managers are long or short, you can see in 2007, right before the crash, these guys are almost all long, 80, 90, 100% long, right? Even before the correction, 2011, in 2013, 14, right before the correction there, 15. But these guys are almost fully long this summer. So that, to me, is another a sign that these guys everyone's overextended, they're too long, they're too bullish, et cetera, et cetera.
Mm. Well, the margin debt also, went up quite a bit over the past couple months too, which is not good, for people. So,
Time to party again, right?
Yeah. Well, that's the problem is people, the more something goes up, the more people want to buy it. And then, when it drops, they sell they sell after extended drops when they need to be doing the opposite. And that's what we're trying to do and encourage people to do. And, sell stocks, that's how you make money at this point. And you can buy puts to bet against stocks or short sell stocks, or use exchange traded funds. And I was going to talk about that. Maybe we should save that for another time. It's more important to talk about, the current situation at the moment. But
I think,
go ahead.
I think the real situation right now is the risk reward earlier this year was being long gold more than being short stocks. Now the risk reward is more being short the market than a long gold. So right now,
I would say for the next 90 days or something.
I would say for the next 2 months. Yeah. Like 90 days is 3 months. But yeah. For the next 2 months, that is what I think. That's a better risk reward. And maybe at the end of the year, if the market does really tank this fall, the risk reward will be getting back into gold stocks.
Well, are you good with doing we didn't talk about this at all, and I'm kind of surprised.
Let's do the promotion.
Okay. So, because I don't, the timing is right now, really. Why wait, for another week or so or whatever. So.
And look at one thing, Mike, that I think I maybe talk about a little more than you.
Yeah.
I really believe in in these market seasonalities, right? That's actually another reason that I turned kind of lukewarm in the gold stocks, because from August to September into November, the gold stocks tend to decline and correct. And the stock market tends to do poorly from August into October as well. So that is a major part in my thesis right now, on top of all the reasons to be bearish, that this is the time of year to be bearish. Sell in May, go in ways, they say. But it's mostly more than May, from the summer into the fall. And like last year and 14, even 2011, 2010, even during the bull market, that if you had sold in the spring and waited for a correction in the August, September, October period, and I really think we're going to see a correction or something worse from now to the end of the year.
Yeah, at the very least, we're having a real correction. I mean, that's it could be worse. So there you go. Well, I'll for the people watching this live on Friday, I'll put the link to get Dave's offer and get into his private service on the blog post with this video. I'll put it on there Saturday morning. Could you tell people what they get?
I have podcasts, videos. I think the biggest thing that I have is I have these trading updates where I'm buying this option, I'm buying this ETF, I'm buying this stock. Actually, I give my readers the opportunity to be in a private placement if you're interested in that sort of thing. But it's more the actual, like, okay, I'm buying options of this, stock. This is the price. This is the expiration date. I'm buying 2,000 shares of this stock. Blah blah blah. So it's like, if you want specific buy and sells. And by the way, I'm not a day trader. I'm doing these as position trades, and we're going to hold for a few months. But if you're interested in that sort of trading, I think that's my service is really good for you. And by the way, the way I've structured my option trades, I'm looking for stuff that if we get a big decline in the markets, that can go up 15, 20, 30 to 1. Actually, one of the trades I have, it's a lottery ticket. I say the chances are very low, but if it happens, it's 100 to 1 kind of trade. I'm not saying that as BS. I'm saying this because I've worked out the math of it. If there is a big kind of trade, and if you're interested in that sort of thing as a hedge, perfect for you.
Yeah, that's great. Well, thanks for taking the time to talk to me and everyone else. And obviously, with what's going on, we haven't talked like this for a while. We'll be doing this more often.
Yeah, for sure.